Have you ever wondered why businesses expand into international markets? Apple, Coca-Cola, and McDonald's decided to sell their products in other countries. But what drives these decisions? The two main factors that influence businesses to trade internationally are known as push factors and pull factors. Push factors are challenges or limitations in a company's home market that drive it to look for opportunities abroad. A saturated market is an example of a push factor that would make a company look at expanding internationally. A saturated market occurs when almost everybody who needs or wants a product already has it, leaving little room for further growth. Companies in these situations may struggle to increase sales and revenue domestically, pushing them to seek international markets with untapped potential and a new set of customers to sell to. In the US, McDonald's operates over 13,000 restaurants, often with multiple locations in the same town or even on the same street. With limited room for further growth in its domestic market, McDonald's expanded into Europe, Asia, and Africa. Today, McDonald's earns more revenue internationally than in its home market of the US, showing how profitable it can be to expand internationally. Competition is another push factor that may drive a company to look abroad. Intense competition in domestic markets can squeeze profit margins and limit growth. Rivalry with competitors offering similar products often pushes businesses to explore less crowded markets abroad. Despite being a pioneer in the US fast food market, McDonald's faces significant competition from brands like Burger King, Wendy's, and more recently, Five Guys. To escape this intense competition, McDonald's expanded to international markets, including Canada, Europe, China, and India, where rivals were less established. This allowed them to build brand loyalty with a new set of international customers. Pull factors are opportunities or advantages in international markets that attract businesses to expand overseas. These pull the business into wanting to expand overseas, rather than push factors that drive a business away from their home market. One of these pull factors that may attract a business into expanding internationally is economies of scale. Economies of scale occur when businesses reduce costs by increasing production. Expanding internationally allows companies to produce and sell more, spreading fixed costs like advertising and research over a larger revenue base. McDonald's benefits from economies of scale not only by buying ingredients in bulk, but also in its advertising. Creating a TV advert is expensive, but McDonald's spreads this cost across multiple countries by reusing the same ad with minor adjustments, reducing the cost per ad. Additionally, being a global brand allows McDonald's to negotiate better rates for advertising space. Another pull factor is risk spreading. Expanding internationally reduces a company's dependence on a single market. If one market faces economic challenges, regulatory changes, or shifts in consumer preferences, the company can offset losses by performing well in other regions. This geographic diversification reduces risks. McDonald's uses geographic diversification to maintain stability. If European markets slow down economically, McDonald's can continue to thrive in regions like the Middle East. In addition to this, if health-conscious trends reduce demand in one market, McDonald's can test and launch healthier menu options while still performing well in countries where changes in consumer tastes are more stable. This geographic spread ensures that localized challenges do not disproportionately affect the company's overall performance. By understanding push and pull factors, businesses can expand globally, overcoming domestic challenges while taking advantage of new opportunities. This strategy has allowed companies like McDonald's to grow beyond their home markets, building a strong global presence and sustaining long-term success.